Hi there. I hope you're keeping well. Now that we've covered the main types of insurers in Canada, their structures, and the key roles that they play in the financial services sector, the next question is, what is prudential regulation of insurers? And why is such regulation important? So, what is prudential regulation? Well, in one sentence, this type of regulation seeks to promote prudent mindsets, behaviors, and practices in private financial institutions, including insurers. It seeks to promote these prudent mindsets, behaviors, and practices starting at the board of director level, then senior management level, and then flowing within the rest of the organization. This is with a view to promoting sound business decision making and sound risk identification, risk measurement, and risk taking practices. Prudence within a financial institution also includes having adequate capital and liquidity to weather many inevitable financial storms. What storms am I referring to? Well, examples include insurance claims that exceed an insurer's expectations and market volatility that leads to investment losses. But why? Why is prudential regulation so important as it relates to financial institutions, including insurers, versus most other types of commercial businesses that are not subject to this type of regulation? Well, the purpose of this module is to address this question by first stitching together what we have discussed in previous modules and then building on it. All right, so let's go. As we discussed in the previous module, insurers play very important private and public roles. For example, through property and life insurers, insurers protect our assets and the financial interests of our estates. And through liability insurance, they also compensate for damages arising from the faults of others. As we also discussed in the previous module, the successful operation of insurers is largely based on the principle of mutuality. This principle refers to a good distribution of risk among all policyholders and a good distribution of the cost of protection among all these same policyholders. And so the basic mechanism of insurance is that by bringing together homogeneous, dispersed, and divided risks, which are uncertain when considered in isolation, but become more predictable when considered as part of a large group, it becomes possible to protect each person or business who is part of that group. And when the principle of mutuality cannot be achieved, we also discussed that insurers use techniques for sharing risks with other insurers, such as reinsurance. Now, let's push this a bit further. When the principle of mutuality, combined with risk sharing with other insurers, if applicable, are well implemented, then liquid reserves are generally only needed for a small fraction of the total insured risks. Again, when the principle of mutuality combined with risk sharing with other insurers, when applicable, are well implemented, then liquid reserves are generally only needed for a small fraction of the total insured risks. This is because the amount of money that insurers normally have to pay each day as a result of valid insurance claims is only a small fraction of the premiums and other income that they receive. When insurers anticipate the possibility of significant deviations from this normal course, then they generally turn to risk sharing with other insurers. Okay, so as I mentioned previously, in their normal course of business, the amount of money that insurers have to pay out on a daily basis as claims is only a fraction of the premiums and other income that they receive. As a result, insurers make investments with the excess money to make a return on it. Some of these investments are liquid and short-term, such as money market funds, but others, and especially in the case of life insurers, are long-term and not liquid, such as investments in commercial property or infrastructure assets, such as bridges and toll roads. All of these decisions are based, in the case of insurance operations to a large extent, and in the case of investments to a lesser extent, on the study of probabilities. In other words, the anticipation of the future from the past. Thus, if we combine all these elements, we can see that insurers can be exposed to low probability but high impact risks. For example, what happens if an unanticipated large number of valid claims are made at the same time to a P&C insurer as a result of the increasing severity and frequency of climate-related events? Here's another example of a low probability but high impact risk event for an insurer. What happens if the investments that the insurer thought were liquid and safe are no longer so, as was the case with the asset-backed commercial paper crisis in 2007? And here's another example. What happens if the money that the insurer needs to pay as a result of unexpected valid claims are locked in illiquid long-term investments, such as infrastructure assets? In cases where the low probability but high impact risks materialize, there is a turning point for private insurers. And that turning point is in the form of a severe difficulty or even an inability to pay insurance claims and other liabilities. An inability to pay valid claims as they become due means that the insurer has become insolvent. News that a severe difficulty to pay its liabilities as a result, for example, of a fire sale of its investments and other assets can also lead to a loss of confidence in an insurer. A general loss of confidence among its existing policyholders could lead them to not renew their policies with the insurer or even cancel their existing policies with the insurer, each where applicable. A non-renewal means the loss of a customer. A cancellation means the loss of a customer and the obligation to pay any related amount owed to the policyholder. Examples of these payments owed by insurers are the cash amount set out in a permanent life insurance policy, and in the case of a canceled P&C policy, the unearned premium. An unearned premium, by the way, is the portion of the premium that is collected in advance by an insurer. In addition, a loss of confidence could translate itself in reinsurers or participating insurers no longer wanting to do business with the insurer. And all of these problems can be compounded by the loss of potential clients. As a result, a general loss of confidence in an insurer can eventually lead to its insolvency and its bankruptcy. In a system of free competition, businesses appear and disappear every day. No one really cares too much about these disappearances except for the people who are immediately affected and their families. When a company becomes insolvent or even bankrupt, shareholders lose money and employees lose their jobs unless another company takes over the business. And except in the case of very large companies, insolvency and bankruptcy is seen as a natural part of the business landscape. This, however, is not the case for private insurers. If these financial institutions were the subject to the same rules as other non-government businesses, policyholders, as well as successors or estates in the case of life insurance, and third-party insureds in the case of liability insurance, would lose their insurance protection if their insurer failed. The failure of a life insurer can have very unfortunate consequences for the beneficiaries of a policy. For example, a spouse or a dependent child of a policyholder. In the case of a P&C insurer, imagine, for example, a family whose house has burned down and then learns the catastrophic news that the insurer who owes them an indemnity of several hundred thousands of dollars is unable to pay it. Or imagine, for example, a victim of a car accident caused by a driver's negligence who becomes quadriplegic but is unable to access the million or more dollars owed to them under liability coverage to indemnify their losses because of an insolvent insurer. The important private and public or societal roles of insurers, the risks associated with their operations and the investments that they make, and the significant financial implications of an insurer's failure vis-a-vis, for example, its policyholders, its insureds, the beneficiaries of life policies, all lead to the need for prudential regulation. With regard to insurers, the key objective of prudential regulation is to protect the financial rights and interests of their policyholders and other insurance creditors. So let me repeat. With regard to insurers, the key objective of prudential regulation is to protect the financial rights and interests of their policyholders and other insurance creditors. This is the so-called micro role of prudential regulation of insurers. The macro role of prudential regulation is the subject of the next module. Now, to expand on this micro role of prudential regulation, I'm going to quote pages 12 and 14 of the 1985 Green Paper. Quote, millions of Canadians have entrusted their savings to financial institutions, and a large proportion of them know little, if anything, about the risks that those institutions are incurring in the course of their business dealings. A way to protect these people is to provide some assurances that the institution with which they deal will be in a position to live up to their obligations by requiring the institution to observe standards of prudency. End quote. Thus, the micro role of prudential regulation in regards to private financial institutions generally is to protect the financial rights and interests of their policyholders, depositors, and other creditors. This is done by substituting private supervision by some of these creditors with collective prudential regulation and supervision by a government body. In a later module, we will address this government body at the federal level. namely the Office of the Superintendent of Financial Institutions, or OSFI for short. To sum up, insurers play very important roles, and their operations and investments expose them to risks, including risks that are very significant. These risks can lead to their insolvency or bankruptcy, which are events that can have enormous negative impacts on their policyholders and other insurance creditors. For this reason, insurers are subject to a regulation that encourages them to act prudently. And as mentioned in the beginning of this module, prudential regulation seeks to promote prudent mindsets, prudent behaviors, prudent practices in private financial institutions, including private insurers. This is with a view to promoting sound decision-making and sound risk identification, risk measurement, and risk-taking. Prudent practices also include having adequate capital and liquidity to weather many financial storms. So this is the end of this podcast. Until next time.